Ladies and gentlemen, good day and welcome to the Microfinance and SFBs Sector Overview and Key Trends on Growth, Profitability and Asset Quality conference call. Today's conference is being recorded. At this time, I would like to turn the conference over to Aniket Deshpande. Please go ahead.
Good afternoon, everybody, and welcome to the third in Liberty Capital series of webinars that we have been conducting. Some of you may be aware that the first two webinars that we conducted were on the NBFC universe as a whole, where in the first webinar we tried to talk about the asset side and our analysis of performance on the asset side, whereas in the second webinar we focused on the liability side of balance sheets for the NBFC universe, focusing specifically on ALM in the context of the current environment. Going forward, we will be conducting webinars with a deep dive into specific sectors within the NBFC universe, starting today with microfinance. In today's presentation, I will try to cover our assessment of what holds the microfinance model in the current scenario. We will also then move on to trying to dispel some of the long-standing myths about the microfinance model, covering points such as overheating, over-penetration, market potential, and so on. We will then move on to what our assessment is of risks in the microfinance model, and then follow it up and conclude with our outlook of the future of microfinance going forward. Starting with a brief introduction and a snapshot of the sector as it currently stands. To the top left of your screens, you will see an overview of the sector split into different vehicles of microfinance, of dissemination of microcredit in the sector, in the economy today. What we see is that in terms of growth rate over the last 5 quarters, while banks have been the highest, and this includes microfinance only banks such as Bandhan, but also includes other banks which are operating primarily through BC portfolio. If we compare this or juxtapose this with the average ticket size, we find that to be the lowest with the NBFC MFIs. The juxtaposition leads us to conclude that NBFC MFI as a vehicle is the fastest or the best suited for fastest client acquisition in the microfinance model. This is primarily because of the outreach and the rural last mile reach that NBFC MFIs have developed over the years. Going over to the graph on the top right of a corner of your screens, you'll see that portfolio quality over the last 2 years, which has been much spoken about, has actually stabilized very significantly over the last few quarters. And across the sector, now we are seeing the trend where a recovery is well and truly on course post the event of demonetization that happened 2 years ago. On the bottom half of your screens, you will see graphs that cater to or that speak about NBFC MFI data alone. What we are seeing over here is that leverage by NBFC AUM category or MFI AUM category is actually the lowest among the large size MFIs, which goes to show that it is the large size MFIs which have enjoyed better capitalization and access to capitalization over the last few years. At the same time, if you juxtapose that with the bottom right graph on your screens, you will see that return on average assets or ROA is also highest for this this segment of MFIs. What we'd like to conclude from this is that NBFC MFIs at scale can offer an ROA of 4% or in a sustainable manner through an event risk, and therefore prove themselves to be investment-worthy vehicles. We'll move on to our assessment of what we think the model is holding the model now. We think this is what we call the new normal. It is a combination of factors which have been true to microfinance over the last 20 years that it has been in existence in India, as well as some of the newer things that we are seeing on the field with some of our MFI partners try to operate with. I'll divide this section into two specific categories. One is the operating risk management piece, and the other is the organizational risk management piece. And what is holding the model from an operating risk management, firstly, is one of the oldest and the most significant things from a microfinance client perspective, which is self-selection of borrowers, which translates into social collateral under the joint liability group. It's important to understand that self-selection and social is one of the key factors that lead to social collateral. In our assessment, it is even more so than the actual imposition of joint liability by MFIs. And we've seen some of this play out over the course of the years where an unevenly formed group or a group formed without the borrowers selecting themselves or without borrowers consenting to addition to the group have actually performed adversely in comparison to groups which have selected themselves. We think this holds just as true today as it has in the past, and therefore group is not only a medium of OPEX management, but also continues to be a very significant medium of controlling credit quality. Having said that, moving on to the second point, having said that, we feel that client filtration using quasi-credit mechanisms is becoming increasingly important, and we are seeing more and more of our MFI partners trying to take a client view. What I mean by this is that we are seeing MFIs go beyond filtration using only credit bureau data, as has been the norm for the last 5 or 6 years. But right as things stand, more and more of our MFI partners are using both quantitative and qualitative techniques to filter clients before disbursing to them. Most common among this is actually having a non-business person labeled a credit person meet with and assess the credit of every single client before disbursement. The credit assessment over here is very different from what we are used to seeing in other NBFC asset classes or other retail lending asset classes. But we feel that this is a work in progress, and MFIs are finding their own feet in terms of defining what the process should be for them. But at the very least, we feel that developing client view goes into trying to estimate whether the household income supports the loan, whether what indeed the economic activities are at a household level, and whether the loan is actually required by the customer. Collections. Microfinance historically has been one of the only models of lending where the loan officers or the collection officers of the MFIs or lenders go on a periodic basis, weekly, fortnightly, or monthly, to almost the doorstep of clients to collect the installment. We feel that the regimental discipline around the center meeting and the process of the center meeting itself is key for an MFI success and for the loan officer to maintain a relationship with the client. But lastly, coming back to some of the newer things that we are seeing in microfinance in the operating risk management, we feel that data digitization is become the norm with unique identifier in the form of Aadhaar become almost ubiquitously available. This has led to significant improvement in efficiency, significant lesser intervention requirement from NBFC loan staff or MFI loan staff, and essentially we feel that this will lead to a better credit ecosystem. Moving on to organizational risk management, we feel that central oversight of expansion and central oversight of growth is critical. The way we see this playing out among our MFI clients is varying, ranging from risk management teams of our MFIs having views on which branches or which areas to open branches is, in extending to in existing branches which new areas to operate in. But we feel that discretion in area of operation and client selection being taken away from the field staff is adding another layer of credit quality and comfort to microfinance players right now. Next, in terms of organizational diversification risk management, we feel that asset diversification and top-line supplementing is becoming the key. I think the discourse, or we think the discourse has transitioned from increasing efficiency by overloading the loan officer to ensuring that your top line is sufficiently supplemented, whether it is in the form of cross-sell of non-financial products or by diversifying into other asset products itself. And these could include assets that the customer needs, such as consumer durable loan, two-wheeler loan, or it could include a more nuanced product such as an MSME loan. And lastly, it is the de-risking on the liability side or diversification on the liability side. We feel that in the current scenario, MFIs are cognizant of the fact that a very highly leveraged balance sheet is not something that an MFI should operate with or can operate with over a sustained period. And therefore, we feel that de-risking both in terms of getting larger doses of equity at periodic intervals, as well as diversifying the debt itself in terms of providers as well as instruments, both in on-balance sheet and off-balance sheet instruments, is becoming the key of any well-managed MFI going forward. We'll move on to the second section of our presentation, where we are trying to address some of the myths or some of the often repeated questions that have come to us over the years that we have represented the sector to investors. We have tried to address these myths or these questions using hard data that we have access through public sources and purchased from credit bureaus and analyze that at our end. I'll hand over to my colleague Aditya for the first piece of this section.
Yeah, so the first question that we will tackle is, has the market for microfinance saturated? Now the market as it stands today is about 2.23 lakh crore. This includes the SHG bank linkage program as well as microfinance credit through banks and NBFCs. The banks and NBFC universe has grown at a CAGR of about 44% over the last 3 years. Our estimate based on population data, income levels, etc. shows that there is an eligible borrower population of 180 million, and at an average ticket size of around 30,000, which in our opinion is a fairly conservative estimate, we see that the market has potential to grow at a 35% CAGR over the next 3 years, taking this to 5.5 lakh crore. Now, within this growth, we believe NBFC MFIs will lead the charge on account of multiple reasons: capital, regulation, their ability to service these customers, and the proximity that NBFC MFIs enjoy today to some of these growth pockets, which we will cover in the next slide. Our view is that while market expansion here will be a mix of increasing customers as well as low ticket size, it is to be driven more by the former because of the potential that we see as it stands today. So some of the key growth drivers, the rural story is something that we expect will play over the next few years. There are multiple proxies that point to this already. Automobile sales in rural have consistently outpaced that of urban over the last few years. This can be observed across a couple of other matrices, which builds confidence, and MFI portfolio growth, urban versus rural, also points to the same conclusion. On the market itself, we see that close to 50% of the universe is not touched by lenders in terms of PIN code data that we see from Credit Bureau. This universe continues to be able to access equity and debt including off-balance sheet transactions and other structured products. So overall, we believe that NBFC MFIs are well positioned to ride this growth story because of an enabling regulatory environment, a proven operating model, and a lot of these other factors that we just discussed. The next question that we will tackle is, are customers over-leveraged because of competition forcing people to go after the same customer? Now, this market growth is a function of two variables. One is the increasing customer base, and secondly, the increasing loan ticket size that is disbursed to these customers. Now, the charts to the right show that there is a 22% growth in the live customers. This number could have been higher but for demonetization, because you notice that the growth gradient sort of reduced between March 16 to 17 because of a lot of entities going slow in Q4 of FY17. Loan ticket size, on the other hand, has grown by close to 10 to 11% during this time frame. This lends credibility to the 35% growth story that we envisage that this industry will go through over the next 3 years. And this growth will not necessarily increase indebtedness at a borrower level. And like Aniket had discussed in his initial preamble to the presentation, we see an increasing adoption of a client view across MFIs, where indebtedness is being extended beyond the borrower to the household. And these practices, as they get more and more adopted by the universe, will cap indebtedness at a borrower and a household level, keeping this under check. The next question that we will take is, are we seeing overheating in some pockets of aggressive disbursements? Now, there are two charts on this slide. The chart on the left indicates the principal outstanding as of June 2018 by state. The chart on the right indicates a 12-month growth rate of principal outstanding by state. If you notice the part that is circled on the right side map, the eastern market has seen a substantial expansion and will continue to do so over the next few years. So we will take a couple of examples, Odisha and Bihar, to understand if the increased penetration of MFIs has adversely resulted in overheating, etc. So first we will take Odisha as an example. So the charts on the top half indicate the number of microfinance operators present across 3 different time periods: March 17, March 18 and June 18. The increasing shades would reflect a more deeper penetration, and you would notice that there is a significant change that has been observed over these 3 time periods. But however, once that is viewed in line with the average loan ticket size at a client level, that chart has hardly moved over these 3 time periods, which can help us conclude that lenders are not going after the same customer or lending to the same customer. New entrants, even in a deeply penetrated geography, are able to find pockets of expansion, and these pockets of expansion, like we discussed earlier, will be driven by the rural growth story in our opinion. A similar snapshot is provided for Bihar, the top half representing the number of MFIs operating across 3 time periods, the bottom half representing the loan ticket size at a client level across these 3 periods. The same trend would be observed here as well, where the number of MFIs operating has significantly changed over this time period, whereas loan ticket size at a client level has not meaningfully moved. So our conclusion is that there is room for expansion across markets, even deeply penetrated markets, and entities have been able to find those pockets and not necessarily go after the same customer. We'll move on to the next question, and Aniket will take over again.
Next question we'll try to address is whether microfinance portfolio behaves adversely around elections and announcements of loan waivers. So we have taken these 2 phenomena separately and have tried to assess it using data. To begin with, we have examined 2 states of West Bengal and Gujarat at the time of elections. Where we compared portfolio with 1 quarter prior and 1 quarter after the election event in either of these states. If you would recall these elections, there was no overt announcement of loan waiver in either of these elections. What you will see on your charts with the maps of West Bengal and Odisha is a district-wise assessment or demonstration of whether PAR in those districts has increased or decreased pre and post the election. The grey shade denoting decrease in PAR and the blue shade denoting increase in PAR. We feel that in both West Bengal and Gujarat, data shows that in both West Bengal and Gujarat, post-elections, there was a marked decrease in PAR. Of course, in West Bengal, this data is a bit colored because PAR for some reason had risen quite significantly in December 2015, and therefore the decrease in portfolio pre-elections has also been quite sharp. It may be that pre-elections, especially in West Bengal, which was pre-demonetization, there was a large influx of cash among the population of microfinance borrowers, which led to somewhat decrease in PAR. But that is just a hypothesis and conjecture. What we can conclude, however, is that elections don't adversely impact portfolio quality. Moving on to whether agricultural loan waiver announcement of impact portfolio quality. Over here, we have examined the states of Uttar Pradesh and Maharashtra around the time that agricultural loan waiver announcements were made in these states. In Uttar Pradesh and UP, it was in April 2017, whereas in Maharashtra, it was in June 2017. Listeners would recall that in both states, portfolio quality had deteriorated quite sharply in the last quarter of FY17, and this was around the clamor for loan waiver of both microfinance and agri loans. In both instances, we are seeing that post the announcement of loan waivers, PAR has degrown quite sharply, and this has been more or less uniform across districts in both states. Maybe there are 2 or 3 districts where PAR has increased, but otherwise PAR has been on a decreasing trend in the quarter immediately succeeding the loan waiver announcement. Now, our estimate or our understanding of this phenomenon is that a loan waiver announcement, if carried out by state governments, has been very categorical in stating which loans are waived, and of course there is no precedent of state governments waiving MFI loans, and therefore agricultural loans were categorically stated in the communiques issued by the state governments. A lot of credit over here goes to the industry players and the regulatory and quasi-regulatory, self-regulatory bodies as well, which have engaged with and lobbied with state governments in ensuring that this communication is clear. But we conclude that agricultural loan waivers announcements do not adversely impact microfinance portfolio. In fact, if anything, there is a positive impact, again, because there is an increase of cash available with the microfinance borrowers post the loan waiver announcement, at least in the rural areas where there is a overlap with the agricultural loan borrowers. The next question we'll try to address is whether microfinance portfolio is vulnerable to natural calamities. We have specifically looked at the natural calamity of flood. We have looked at floods in 3 different time periods and 3 different locations. We have looked at the most recent Kerala flood in August 2018, the Bihar flood in August 2017, and the Chennai floods of December 2015. In all 3 instances, we find that microfinance portfolio is impacted, but for a limited time period only, which is to say that when the flood event occurs, in the quarter immediately succeeding that event, we see a dip in collection efficiency as well as an increase in PAR. However, invariably we are seeing this to be a one-time installment skip only by customers, and in the subsequent installment they are able to repay or they are at least able to come back to paying 1 installment at a time. We see this from the data that we are mining through the securitization transactions that we are curating, and this is presented in the table on the bottom left of your screens, where we have looked at data from our portfolio exposure to Kerala. It is only the customers that we have put in a red rectangle over there or circled in red over there are those which have defaulted or delayed installment on account of the floods, and you'll find that in both instances the zero bucket or the first default by a customer or PAR 0 is significantly lower from 1 month to the next after the impact of the flood. So between August and November, we have seen that a large percentage of customers have skipped 1 installment but are repaying the next one, and any customers that were already or that are appearing in higher delinquency buckets were there before the floods itself. And therefore, we don't feel that natural calamities such as floods have a sustained impact on microfinance. We would have liked to assess impact of earthquakes and other natural calamities as well, but we don't have sufficient data to go for that. Lastly, we'll try to assess whether lenders have lost money in microfinance. To this, the publicly available data that we looked at which shows us that no MFI has defaulted on an on-balance sheet capital market instrument since the AP ordinance or the event of the AP ordinance in 2010. This is at a larger universe where we obviously don't have access to bilateral loan defaults that some MFIs may have done. However, in the portfolio of MFIs that we have observed, which are the 40 largest or the oldest MFIs in the country, we have not seen any default post the Andhra event of 2010. We have seen post-demonetization a few asset-backed securitization transactions that have been downgraded to default or D category, especially in the period of 2017 where collection efficiencies were low on a sustained basis in some of these transactions. However, we have seen in most instances recoveries come through in these transactions, and the default ratings have subsequently been withdrawn. In fact, if you look at the rating actions over the last 5 years in microfinance, we find that both asset-backed securitization as well as balance sheet rating actions have seen very, very negligible downgrade, 3.4 in case of balance sheet rating and 3.55 in case of asset-backed securitization rating. In ABS, we see upgrades come to almost 63% of the transactions that MFIs do, whereas in balance sheet rating actions on an annual basis over a 5-year period, 82% get reaffirmed and about 15% get upgraded. However, speaking about the asset-backed securitization transactions that have seen some losses post-demonetization, again over here, what we feel is that the good proxy for ongoing based loss assessment is what the rating agency is denoting as credit enhancement number to be taken for asset-backed securitization transaction. What we are seeing is that except for a brief spike in late calendar year 2016, rating agencies have primarily maintained a view of an average 20 to 21% credit write-off protection in the form of both internal and external credit enhancement, which again goes to show that losses are extremely unlikely and are only likely if overall losses in the pool exceed 20 to 20% odd, and therefore rating agencies are comfortable with this number. Therefore, our view on whether lenders can lose money in microfinance, we can go by past data, and we feel that there has been not been any money lost on on-balance sheet transactions in the last 5 years. I'll move on to the key risks in the sector, and for which I'll invite my colleague Abhijit to chip in.
Thanks, Aniket. So now we would look at the key risks in the microfinance space, and how do we mitigate these losses from these risks. And is there a possibility of eliminating such risks or just mitigation? So looking into the first slide of this particular section, we can broadly bucket the risks in the microfinance space, or rather let me put it, key risks in the microfinance space under two broad heads. The first is the socio-political risk and the second being the operational risk. The socio-political risk that we are referring to in this particular slide and section is not related to loan waivers, elections, etc. that we have already discussed. What we are referring to here are primarily localized events arising due to microfinance borrowers rallying to sentiments and due to severe hardship of some of the borrowers. Let me take a minute to explain what we are trying to say here. Basically, some of the, say, a couple of borrowers or few of the borrowers, because of different KYCs or because of different practices, got into multiple lending or over leverage. Now, this was an opportunity used by some local elements to fan sentiments against the microfinance borrowers itself. Some of the districts where we have seen such kind of events fanning out, primarily in 2015, 2016, would be Burhanpur, Amroha, Akola, Amravati, Narsinghpur, etc. However, these are, as we said, these are also driven by short-term political gains. Now, such events impact all the lenders across the board in working in that geography. But we have seen active participation from various stakeholders, as Aniket also mentioned, from the SROs, from the lenders themselves, interacting with local politicians, district collectors, etc., and able to manage and contain such risks within the locality or within a smaller pocket of geography. We have not seen such incidents occurring in the last 1 year or so, and the industry has done pretty well to manage these risks. Operational risk is an age-old risk for the microfinance segment. Some of the key risks related to these are KYC frauds, underwriting standards, inherent risks of cash handling. However, these have been addressed to a very large extent by the players through use of technology, people, process management, field rigor, etc., as we will discuss in further details in the next slide. First, we talk about the KYC. This has been managed pretty effectively with the introduction of Aadhaar. The recent developments indicate that eKYC is no longer going to be the norm. However, in our opinion, UID or Aadhaar remains the primary KYC. There is 90% plus seeding within the borrower segment of microfinance with Aadhaar. And we do not expect voluntary refusal in this particular segment, or it is expected to be low. Further, within Aadhaar itself, the use of QR code scanning, basically what we mean by this is rather than punching in data by any of the, by a human element, the QR code is scanned and the data is automatically captured by the system. So far, our experience is the QR code tampering is more difficult than just document tampering, and therefore a better way of managing the risk. This is, so it's less prone to tampering itself. The combination of these two puts the industry in a sweet spot, with a probability of KYC frauds being significantly lower than before. The second area that significant work has been carried out by MFIs within the operational part of it is developing and nurturing groups and staff members, and we expect them to continue to do the same. Staff members, based on our field experience, what we have seen, and based on interactions with them, they are not only imparted about the organization or the regulatory changes on a regular frequency, but they are also upgraded or in their soft skills. This helps them in even moving further up the ladder. Diligent borrower training continues, and the focus is on empowering this vulnerable set of borrowers itself. We are seeing technology playing an increasingly positive role in the field. with oversight on the geographical concentration. We will discuss this further in the next slide, but there has been control on borrower addition from the head office itself through use of technology. Tracking and monitoring of field discipline, basically the movement of the field staff, the duration of the field meetings or the center meetings, that is also tracked to identify early warning signals, as well as better identification of customer residences and intelligent data gathering to better understand the customer. Again, this last part would be discussed in detail in the last section, but this is to better address the needs of the customer and not just looking at them as a microfinance borrower, but having a holistic view as a client view that we have been discussing. We have also seen strengthening of credit bureau usage. So rather than having just a microfinance debt outstanding view, we are seeing MFIs piloting complete household debt level view. So checking retail database, checking of the agri loans that are there, agri indebtedness, and comparing it to the repayment ability of the household rather than just looking at the regulatory norms. We expect this trend to increase going forward and client view being the primary focus. While investment in people and processes are expected to continue, we expect the microfinance players to operate at a healthy operating expenditure levels. As we can see from the chart at bottom left, the players have been able to operate at 7 to 7.5%, the mid-sized ones. And we have also seen in our experience the larger players witnessing decline in operating expenditure by 50 to 60% over the last 8 to 10 years. The employee expense continue to form the largest portion for these players at 70 to 75%, with the players able to reduce the overhead expenses at branches with stabilization in operations. The third segment of the risk is the cash. Now, MFI operations are expected to continue to be decentralized. Cash is expected to move with various hands, including the field level staff, the branch manager, etc. There is an inherent risk of cash handling that we are all aware of. But with the move to cashless disbursements, the inherent risk associated with cash handling at one leg has been addressed quite significantly. The cashless disbursement stood at 87% of the total disbursement in the NBFC MFI universe, increasing from 60 to 70% within a year itself. We expect this number to increase further. Although cashless collections have a long way to go, the cash-related risks on the collection front have been addressed by daily reconciliation of cash, which is a practice which goes back even more than 5 years. This has been further improved through use of technology. We are seeing players tracking the collections real time. So whenever the field officer collects cash in a center meeting, updates it in the tab, it reflects immediately on their senior as well as the head office. So if there is a delay, they can even track it. We believe that the cashless collections will increase while maintaining the rigor of group meetings, further reducing the cash management risks. Moving on to the third slide in the section, addressing the key mitigants. In our opinion, eliminating the risks is something that is not really possible currently. So what are the mitigants that we are talking about? There are two: geographical diversification as well as balance sheet loss absorption capability. With local geographical risks being one of the key risks in the sector, we believe geographical concentration management should be the focus of the players. We are not talking only about a state level diversification because smaller entities could run risk of spreading the resources too thin, but at a granular level of risk or granular unit of risk, that is district, pin code or village levels. As best practices, we have seen MFIs capping addition of borrowers at pin codes and village levels, capping branches at a district level, and not even falling in the trap of increasing the staff members at a branch because the number of branches itself are capped. Geographical expansion would continue to lead to higher number of pan-India players as well as smaller players moving into neighboring states, diversifying within districts, and continuing to invest in people and processes. Talking about the balance sheet ability to absorb shocks, we have seen that the average losses over a period of time are close to 2%, but the spikes on account of event risks make the balance sheet strength important from our perspective. Demonetization provided us a real-time example for that, and we saw that this particular shocks do not really lead to solvency risk for a MFI or a microfinance player, but it's more of a temporary shock. So with a credit cost of 2% and what Aniket discussed about the return indicators on the first slide, we feel the MFI players are well positioned. We would look into equity flow into the sector and interest from various players in the next section, which I hand over to Aniket.
We'll move on quickly to our outlook on the future of microfinance. A couple of different aspects to this before we conclude. The first aspect is the small finance bank piece. A lot of what we covered in terms of asset performance, backing data and dispelling myths is of course as applicable to SFBs disbursing GLG portfolio or managing GLG portfolio as NBFC MFIs. But SFBs as different legal vehicles or different legal forms themselves have had a tough couple of years in terms of transition. This is because they have had to diversify both on the liability side and on the asset side. What we are finding in conversations with SFBs is that liability strategies are somewhat similar across the board. Obviously, SFBs are finding pockets within this strategy to be able to grow in a differentiated manner. However, most SFBs are targeting for retail deposits mass affluent customer base similar to private sector banks that have grown in the last 10 to 15 years. And in the initial phase for bulk deposits to cooperatives and PSU institutions. Access to capital markets through CD issuances is likely to pick up more over the next couple of years, although we have already seen some of the larger SFBs access this with quite a bit of success in the last 12 months or so. We feel that improving the deposits franchise will feed into product diversification outside of GLG, and I'll talk about this a bit more. While NBFC MFIs that have converted to SFBs have demonstrated deposits growth, a lot of this, as I mentioned, has not been to their core asset customers, which is also something which will only grow as time progresses. The graph at the bottom left of your screen shows the overall deposits to assets ratio of the 5 SFBs that we covered quite extensively. All 5 of these are MBFC MFIs transition to SFBs. Some of them are quite large and are listed players as well. What we see is that on an average, SFBs are demonstrating a 60% deposit to advances coverage ratio at the end of June, which has over the preceding 3 quarters almost doubled. It will remain to be seen, however, if they are able to see the same pace of growth while doubling this once more. Because if we compare it with the deposit to advances ratios that small private banks are maintaining, healthy D2A ratio would be in the range of 115 to 120% to ensure unimpeded growth on the asset side over time. We therefore feel that it would take at least 12 to 18 months for SFBs that have transitioned from microfinance to be able to demonstrate this. On the asset side, some of the larger SFBs have actually diversified quite significantly away from JLG, and the others are following suit. However, what we are seeing as an emerging trend over here is that here too SFBs are actually banking on their non-core customer segment to be able to provide asset diversification with minimal credit costs as well as OPEX. To elaborate a bit over here, the diversification that we are seeing in the MSME space is in the secured lab space, which is in the 14 to 16% yield range. We are seeing diversification into vehicle finance to small fleet operators as opposed to single first-time users in the used vehicle category. We are seeing two-wheeler finance focus on new two-wheeler versus used two-wheeler. Gold, housing finance, etc., and wholesale lending are also assets that will demonstrate stable and predictable asset quality over a period of time. So clearly, SFBs are concerned with the need to maintain a secured multi-asset balance sheet, perhaps owing to the fact that all of them started in the shadow of demonetization. But we feel that it has been the stated, and it is the stated purpose of almost all SFBs to become transition to a 50% secured balance sheet, and we feel that this will realistically be possible only once the liabilities franchise is stabilized. So while the larger SFBs have done very well to diversify away from JLG, transitioning from 95% JLG to 80% among the largest of these, and 40% among an already diversified SFB, and the others are following suit. We feel that meaningful diversification and sustained diversification to a period when JLG as an asset is a PSL balancer as well as a yield kicker balancer will happen only once will be taken up in earnest only once the deposit franchise stabilizes, and will take another 2 to 3 years from now. Having said that, in conclusion to this section, we feel that SFBs will continue to remain very significant players. We don't see any instances of SFBs actually diversifying balance sheets by degrowing the microfinance or JLG portfolio, and that one of the reasons could quite simply be that JLG as an asset stabilizer and a yield kicker, because it is a high yielding asset compared to the others that they operate in, is significantly more remunerative to SFBs. I should mention over here that almost all SFBs have operated in the PSLC market with quite a bit of success, and that has been a very significant top line supplement to them. I'll move on to what we feel will be the future of the group model itself, and as we have covered over the course of this presentation, we feel that client view will be the differentiator in the MFI model, group model going forward. It will be driven by what we are calling the 3 C's, which is centralized oversight, client assessment, and client retention. Centralized oversights, like we've said, analytics and granular decisions on expansion, area selection, product design, and risk management. We are seeing MFIs move to a big data approach, and we feel that is the way for the future. In terms of client assessment, we feel that intelligent data capturing by a credit officer or a non-business person who meets or who is mandated to meet and assess every single client before disbursement will actually allow MFIs to underwrite for multiple products upfront. We would like to see underwriting and actually undertake meaningful underwriting going forward. And the last piece on client retention is the most interesting piece, because over here, historically, what client retention or client wallet share maximization has been mistaken to mean offering higher ticket size products. Over here, we feel that the loan officer, who we have not spoken about much in the course of this presentation, will take primary importance, because it is the loan officer who will have to engage with the MFI customer and ensure that the customer's experience is optimal. Some of the very best practices and very nascent initiatives that we are seeing in this space include undertaking a loyalty kind of an approach, where an MFI customer, if demonstrates or expresses interest to stick with only one MFI, the MFI can offer a higher ticket size loan with a lower rate of interest. But of course, this will have to be coupled with monitoring the client through the use of credit bureau and quarterly credit scrub to ensure that the customer actually doesn't give in to the lure of another loan from another MFI. It's to be the key to be noted over here is that we are not propagating a higher ticket size. What we are seeing is that MFIs will have to find a way to engage with the customer.
This is Abhijit. Sorry, we have some technical issues. So, as we were discussing in terms of the data digitization and analytics, this is going to be the key for meaningful growth. And as we have discussed in the risk section as well, what we have seen is that better client targeting is going to be the key. And that client targeting is going to be only coming from when we are able to analyze the client better. We have discussed about the other two topics as well. So the geographical diversification is the key. OPEX is expected to remain under control despite this diversification, and better capitalization. Again, as we had discussed, is going to help company in terms of absorption of balance sheet or event risks. Moving on to the next slide, here we see the equity interest. The equity interest in the slide in the sector which is there. Now what we have seen is in the initial part of the journey during 2010 to 2014, the DFIs played a very important role in terms of supporting, which continued till 2016. Private equity players have come in a big way, and we have seen large investments in the recent time period. What is very encouraging here is to understand that the DFIs are making a comeback with smaller players. This is expected to show, this is good news for the sector itself and the smaller MFIs, because PE players, they are looking at in terms of the valuation or in terms of the pool of capital, they have real strength there, but they will be very selective. The support for the smaller guys is expected to come from the DFIs itself. Aside from this, what we see, the consolidation with banks or the IPO market, we have seen in news, etc. on both the parameters. They would hold significant possibilities for MFIs and SFBs going forward. To conclude on the Vivriti outlook, the growth expectation, the industry is in a very sweet spot. The growth is expected to be high. The NBFC MFIs will continue to acquire clients faster based on the various possibilities and the market dynamics that we have explained earlier in the presentation.
NBFC MFIs will continue to acquire clients faster than other kinds of microfinance providers. However, within this universe, we feel that those who will also work towards credit and client view will rise above the pack and attract better valuations. We feel that equity investors see value driven by ability to enhance ROE, which is a combination of off-balance sheet and product diversification. Private equity players are going to be increasingly selective. And also there is the option of future banking play which will entice valuations. However, having said all of this, we feel that MFIs which are a tightly run distribution unit will remain a key target for acquisition by banks and larger NBFCs, and we will not be surprised to see further expansion in the sector going forward. Lastly, a word on the risk. We feel that event risk, to summarize again, event risk continues to be the biggest challenge facing the sector, although we feel that an event is unlikely in this current market to take an MFI down. We also feel that mitigation of losses through event risk is possible through diversification of operations, diversification of products, and tighter control of people and processes. That's been our presentation for today. Thanks so much for your time and apologies for the inconvenience. Operator, can we move to the questions, please?
Thank you. If you would like to ask a question, please signal by pressing *1 on your telephone keypad. If you're using a speakerphone, please make sure your mute function is turned off to allow your signal to reach our equipment. A voice prompt on the phone line will indicate when your line is open. Please state your name before posing your question. Again, that's *1 to ask a question. We'll pause for just a moment to allow everyone an opportunity to signal for questions. We will now take our first question. Caller, please go ahead. Your line is now open.
Hello. Hello.
Yes, please go ahead.
I just want to know about what are the future of microfinance? Is it going to be merged with the banks or it will remain independent? What is that? Can you just throw some light on that?
So like we said, I think NBFC MFIs are fairly bright futures as standalone MFIs. We don't see that because there is a large clientele yet to be acquired that is uncatered to. We feel that NBFC MFIs are ideally suited to grow standalone as NBFC MFIs are themselves. Having said that, we also feel that consolidation or increased consolidation is likely because both banks and NBFCs, large NBFC houses have seen the MFI model to be a fairly useful source of, in the case of the former, acquiring PSL assets, or in the case of the latter, acquiring assets that they would not otherwise cater to.
Okay. Yeah, thank you.
We will now take our next question. Caller, please go ahead. Your line is now open.
Hello.
Yes, please.
Am I audible? Yeah.
Yes, please.
My
Go
question
ahead.
is that based on the latest data of October and November, if you can share that what has been the average cost of borrowings and who are the key players who are lending at this moment. If you can just give a brief on that.
Sure. So I don't have access to publicly available information, so I'll have to rely on my conversations with MFIs in the last 40 to 45 days. Obviously, given that the overall yield curve in the market has seen a significant uptick post September 21st, MFIs have not been immune to that. So what I'm seeing as a translation is that the cost of funds across MFIs has increased by anywhere between 50 to 75 basis points on the conservative side, and on the higher end to about 100 to 150 basis points as well. Having said that, MFIs, especially the larger ones, continue to see securitization and direct assignment or off-balance sheet instruments as useful source of access to cheap money or relatively cheap money. Because of the nature of PSL nature of these assets, as well as the overall banking system's increased proclivity towards buyouts over term loans. And this is a generalization, but that is by and large what we are seeing. We feel that securitization and direct assignment transactions are still competitive. We feel that a high agri or a high PSL concentration pool is still going in the market at 9.5%, which would be about 25-30 basis points higher than what it was maybe a quarter ago. But that will also likely improve as we move towards December and March, which is the latter half of the financial year and the PSL reporting quarter. So in summary, NBFC MFIs by virtue of PSL would be insulated from the overall market rate hike to some extent only.
All right. Thank you.
We will now take our next question. Caller, please go ahead. Your line is now open.
Hi, am I audible?
Yes, please. If you don't mind introducing yourself also.
Sure. This is Nayan. I'm part of the early stage investment team at Matrix Partners. My question is around. My question is around the KYC authentication itself. Now, what has been the impact? So you touched upon this briefly, but would love to understand a little better. What has been the impact of the Aadhaar ruling, and going forward, how does the new methods or the modification of same methods lead to changes or impact on OPEX of the unit economics of these MFIs?
Sure. So let me start by saying that not all MFIs had moved to a complete eKYC system to begin with. What a lot of MFIs had started doing was simply accessing data faster by reading QR codes of the Aadhaar cards. That is continuing undisturbed. What of course the verdict, what it disallows now is pinging the UID database for validation of the Aadhaar card and the customer. That is disallowed now. But that aside, the MFIs I don't think will see a significant impact on OPEX because data digitization itself is continued to be possible. So most MFIs continue to have mobility solutions that with QR code readers that allow them to access information captured in the Aadhaar card. And this does not have an adverse impact on the timeline either or time to disbursement either, because once this data is captured, there is no delay further in accessing the credit bureau and running a credit bureau check on the borrower. This is my understanding of it. Having said that, I think, the point in addition is that I also think there is unlikely to be a significant amount of voluntary refusal by the MFI borrower segment to offer an Aadhaar card as a KYC document. Even though they technically can now, Aadhaar penetration in this customer segment is possibly the highest. I don't think they will be reluctant to offer up Aadhaar cards. So overall, I don't see an OpEx challenge because of time delay, etc. Where we may see challenges, and this is a big may, and it's almost speculation on my part, where we may see challenges is a repeat of a scenario which existed a few years back where there was KYC fraud, which perpetrated by ringleaders and the like, who try to falsify KYC documents, etc. We may see that, but even if that does happen, it will be in a very small proportion because, like I said, Aadhaar with QR code reader is the preferred mode for MFIs, and I don't see too many MFI borrowers being reluctant to go through that route.
Got it. Thanks.
As a reminder, it's *1 to ask a question. We will now take our next question. Caller, please go ahead. Your line is now open.
Hello.
Hi, yes, please. If you don't mind introducing yourself.
Yeah, hi. Am I audible?
Yes, please.
Yeah. Hi, my name is Siddharth. Yeah, hi. My name is Siddharth. I'm from Piramal Capital. I wanted to understand more on this point which you mentioned that microfinance is, they're very limited. They're vulnerable to the natural calamities. So now what has happened in Kerala, what time does it actually take for them to, get their collection efficiency back again to, let's say, about 95 or 96%? And how much time does the region usually takes to stabilize?
Sure. So what we see from data that we are curating from the securitization transactions that we are monitoring is that starting the second month, only about 5% of the delinquent customers or those who have missed the first installment go into the second bucket, which is to say that most or 95% of those customers will come back and start repaying at least one installment at a time, starting the second month. Right now, this number it's a small sample. This number may be larger in the case of some MFIs, etc., who have larger exposure to Kerala. But as a general rule, I would assume that substantial chunk. I would not assume. I would conclude that a substantial chunk of MFI borrowers, in the event like a flood, would be willing and able to start repaying installments at the very least one installment at a time, if not covering past dues, starting the next month itself. What that means is that although collection efficiency may not go back up to 99%, these borrowers are essentially paying with a lag of one installment, and that they can make up over probably towards the end of their loan tenure. So net loss because of floods will be very negligible in that sense. And this is something that we have seen repeatedly across Kerala, Chennai, Bihar, other parts, Odisha more recently, the Ganjam cyclone, etc.
So can I conclude that the region may get stabilized in the next 60 or 90 days?
Yeah, so I think it may be sooner than that, depending on the livelihood of the borrower. So 60 or 90 days will be the outer limit in case a borrower has had significant loss to livelihood as well as to residence and has to temporarily migrate elsewhere to collect some capital and then move back. But essentially, we don't see any beyond 90 days would be a far stretch to see any sustained losses because of that.
Okay, thank you.
Once more, it's *1 to ask a question. It appears there are no further questions at this time. I'd like to turn the call back to our hosts for any additional or closing remarks.
Right. Thanks. We would like to thank everyone who's attended this conference and apologize once again for the breach in connection in between. We hope that the presentation was useful to you, and of course we'll be happy to take questions at a later stage as well. Thank you, everyone. We're disconnecting now.
This concludes today's call. Thank you for your participation. You may now disconnect.